And I think like we're seeing the next evolution of that with like Uniswap v4 and these other modular AMMs, because like they're like, okay, well, if we're gonna, everything's gonna be specialized now, why don't we just be a protocol, essentially like a platform for people to build on top of them? I think that has been the natural evolution of how AMMs will evolve. Is now it's like, okay, well, we're not going to be perfect, so let's let people just build and bring what they want to the table and build on top of it.
Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Today, I'm joined by Austin Adams, the founder of Whetstone Research, and Jesse Walden, founder and GP at Variant. Guys, welcome.
Thank you for having us. Very exciting to be here.
Likewise.
Yeah, this is going to be a ton of fun. So this is going to be an episode which is mostly focused on exchanges within crypto. So mostly focused on DEXs, but a little bit of SEXs as well. And Austin, we're going to spend a lot of time talking about what you're building at Whetstone. But before we get into some of the details, so what are some of the mechanical details of what you're building? I want to start at a 10,000 foot level here and just get a state of the union or state of play on DEXs writ large here. And I think over the course of the last couple of years, we've seen meaningful evolution in terms of the design architecture of many DEXs that exist today. You've seen increasingly that DEXs are eating more and more market share away from SEXs, which I think is something that we're all, very positive on and very supportive of, but also that we've seen some migration in terms of where activity is happening around SEXs in general. And, there's kind of a monopoly that Ethereum had a couple of years ago, and now we see an enormous amount of activity over on Pump Fund. And, it's been interesting to me to see how sticky that volume has actually been and that trading activity has been. So maybe Austin or Jesse, whoever feels bravest here and wants to kick it off first, can you just give us kind of a state of the play state of play in terms of where DEXs are at today?
I guess I can go. So I think like the thing that's really interesting to me on like how DEXs have evolved over the last year or the last few years is like they went from sort of one size fits all solutions to sort of like specific modular solutions. We've seen this over time with like Uniswap v2 and v3 being like really good generalized solutions to now like entire AMMs built around pegged assets, entire AMMs built around specific stablecoin assets, entire AMMs built around meme coins. And we're sort of seeing this evolution of like there's a broader amount of assets being listed on top of DEX markets. They're sort of seeing specialized pieces around this. And I think like we're seeing the next evolution of that with like Uniswap v4 and these other modular AMMs, because like they're like, okay, well, if we're gonna, everything's gonna be specialized now, why don't we just be a protocol, essentially like a platform for people to build on top of them? I think that has been the natural evolution of how AMMs will evolve. Is now it's like, okay, well, we're not going to be perfect, so let's let people just build and bring what they want to the table and build on top of it. And I think like that's the evolution we've seen with Uniswap v4 and these other ones, is that like people are now just building extraordinarily specialized AMMs to build on top and then building on top of these like really lindy secure layers, and then building these like really specific things that like they do one thing really well. And that's like what we're building at Doppler or at Whetstone with Doppler, is like a very specific customized AMM designed specifically for a task of like getting liquidity to market, and then building pieces around that build an ecosystem on top of it. And that's like not possible, right? Previously, it's only possible today with like the innovations that Uniswap v4 and these other AMMs have built.
I might come at this like from so, like I agree with everything Austin said. I might just like go a level higher and more abstract. I don't know if that's helpful, but I guess like my view is, so like starting from this very like sort of big idea, which is like all the world's value is going to be tokenized on chain. That's something that I believed for like 10 years, and that's like what was underlying our investment in Uniswap, 5+ years ago. And I think we're just in the very early innings of that starting to really happen. And, we started with, crypto assets that secure native blockchains. We are today in this sort of like meme coin era, and we're starting to see more and more projects launch token first. We're starting to see RWAs come on chain. So I think this is to Austin's point, like there's all these different types of assets being issued on chain, and for each of them, we're starting to see different types of DEX solutions get spun up. And so where Uniswap started was this very general primitive, that allowed for tokens to be traded. And the thesis back then was, well, if all the world's assets are going to be tokenized, they're going to need a venue to trade. As we've kind of diversified the types of assets, we're starting to diversify the venue as well. And that's happening in two ways. One is the sort of platformization of DEX, which with Uniswap v4, which is a platform for developers to customize things. And it's also happening in a sort of like vertically integrated way where you're seeing platforms like Pump and Virtuals and others like design bespoke solutions. And I guess my view is like, and you see this, I think, a lot in software generally, is like whenever you see developers going full stack to like solve their own problem and like build all the way down to the AMM and all the way up to the end user product experience, like that's an opportunity for someone to build tooling under the hood that just makes those developers' jobs easier. And that's what Austin was mentioning, like they're building this tooling that solves a very important part of the puzzle of tokenizing all the world's value, which is issuance. Right. So if Uniswap is the platform for exchange and exchanging all the world's value, like there's still this other side of the equation, which is issuance, and how do we issue all the world's value on chain and do it in a really efficient way. It's kind of surprising that in 2025 that's still low hanging fruit, and I think that's my view of the problem Austin is solving.
All right, so I want to try to summarize here and then unpack some of these issues a little bit more specifically. So maybe the driving force here is just the sheer amount of assets that are coming on chain, and that could be in the form of RWAs or these, million new pump fund tokens that are spinning up, and anything and everything in between that. So, the actual infrastructure around DEXs is maturing here, and so you've got kind of these platforms that have sprung up, and they're actually doing full stack kind of vertical integration. So that could be Uniswap. That could also be Jupiter over on Solana. And they're kind of running something of the same playbook, right? They bought this controlling stake in Moonshot, right? They've got Meteora as well, some sort of relationship there, roughly maybe sort of same thing. And then you have kind of this tooling layer. And also I want to talk a lot about some of the frictions that asset issuers are having. Actually, I would love to get your guys' take. I wasn't actually planning on going this way, but on the sort of the full stack and vertical integration, because this has been, you actually have seen roughly the opposite of that in crypto thus far, especially in the Ethereum ecosystem. Especially, I've done a whole season on liquid staking with Lido, where we talked with Hasu about kind of having a very flat surface area, and maybe that aligns with how we've historically thought about DAO governance as well. And the strategy is to be very horizontal and very thin. But in the DEX area, you're starting to see the Uniswaps of the world go very full stack. So I would be curious how you guys think about that as a strategy, and if you see that being a trend overall in DeFi vertical integration, or maybe it's something that uniquely makes sense for DEXs.
So yeah, I can start here. I mean, so if you rewind back to when Uniswap first launched, I think it's underappreciated. They kind of were vertically integrated from the start, right? Because they built both the protocol, the very XY equals K AMM, and they built this really buttery user experience on top with Uniswap.org, or the original swapper product, and I think like that had a lot to do with their early success, because that swap product was like a kind of mind-blowing UX relative to what centralized exchanges were offering, what other DEXs were offering at the time. And you could kind of, Khalil, who's the designer back then, like he could kind of intuit this is the right interface for this really simple, protocol, right? X times Y equals K. Like you can have this kind of really simple swapper interface. So it's the right interface, right tool for the job. And so my point being, Uniswap was kind of vertically integrated from the jump. They built the product and the protocol. And I think that helped them bootstrap liquidity because there was demand. Liquidity, came to they also had tooling for LPs early on. So I think that's actually been a pretty effective strategy, not just for DEX, but just across DeFi and really across crypto. Is like you can't just build a protocol. You also often have to build the first product on top that just shows people how to use it and bootstraps liquidity network effects in the underlying protocol. And then so fast forward to today, and Uniswap doesn't just have the front end and the protocol. They also have Uniswap X. They have the wallet, right? So they've gone they've gone both like down the stack from the user product to Uniswap X, the aggregator, and the protocol sits beneath that. And now there's Unichain, right? Which is going to be, or there's soon Unichain, which is going to be beneath all of that. And they've gone all the way up to the end user by building a wallet. And I do think that's very opportunistic, especially in the case of Uniswap, where they've built a trusted brand to go further up towards the end user at the wallet layer. And they're innovating all the way down the stack, and in so doing, capturing a lot of value. So it's something that I think projects that have a lot of distribution are uniquely well positioned to do, but not everyone can do that out of the gate. And so, but there's some slice of that I think is advisable for new protocols, which is like build the first product that bootstraps liquidity in your DeFi protocol.
Yeah, I think the one thing I would add is like Uniswap's well positioned to understand the limits of the or the like infrastructure they're building on top of. They're very it's like one of the largest use cases of Ethereum block space. Like they very much understand the trade-offs that happen on the infrastructure layer. And so like that I think has driven a lot of the decisions of like verticalizing is like, they want like on the wallet experience, they want to control the wallet experience because like one of the reasons they did that was Uniswap X was really difficult to work on with the current wallet UX. And so it was like, if we want to improve the wallet UX, let's just build the wallet because we're going to have to do it at some point. And so it's something similar with like Unichain was like, we want to build all these chain benefits. We deeply understand the trade-offs that we as a product need and how can we build those things. I think like that comes from a lot of expertise and understanding sort of the limits of the current ecosystem. And so I think verticalizing it makes a lot of sense for them because they themselves are very have a lot of experience with that.
Yeah. I want to get a sense from you guys of why you guys think DEX market share has been growing so steadily. So it's actually one of the better charts in crypto, just from my perspective, and people who root for protocols in general over some of their centralized. Not that there's anything wrong with centralized exchanges, but it's cool to see the DEXs win. And I think the other trend is just the sheer amount of assets that are getting issued on blockchains these days. I'm sure Brian Armstrong, the CEO of Coinbase, did a tweet the other day saying, "Hey, they have to take they're basically entirely reimagining what their listing process is, sheerly because of the amount of new assets that are coming online." So maybe you guys could just comment a little bit on both of those trends and whether or not you see them as being related, actually.
Yeah, I'll start. I mean, the premise of DEXs has always been that they are permissionless, right? And the result of permissionlessness in DEX is any asset can be listed without having to go through some complex listing process. So that was always the bet with Uniswap, right? Is like there's going to be a very long tail. Every asset in the world is going to be on chain. And you don't want to have to ask for permission to have a venue for that to trade. And that's why Uniswap was a good bet. It was that simple when I first saw it, like light bulb went off. And so I don't think you can unbundle these two things, right? Like the number of new assets being issued and DEX dominance are directly related. So to me, that's the explanation for what's going on here is like all the world's value is coming on chain, and DEXs are the primary beneficiary of that because they're permissionless.
Yeah, I think the other key thing there is like the UX the on-chain UX is getting significantly better. And so at the core, like if you have the same UX as a centralized exchange, you can get the same trade, or you can get more trades because there's more assets on chain. You can get better execution. Like why would you not trade on a DEX? And so I think like that's also been improving a lot. I would say that wallet UX has gotten significantly better. Chain UX, it's cheaper to trade on chain today. And so it's sort of a bet of like the UX is going to continue to get better. And I think like we've seen this sort of with Hyperliquid. It's like at its core, like people prefer the programmability. They prefer the ability to like control their own assets. And if they have the same buttery UX and the same execution, like there is not really a large benefit for centralized exchanges. I think like that's the key belief that people have when they see that chart, because I the same chart I've seen is like it's just like up only on the decentralized exchange volume share. So I think like that's going to continue to happen as more assets come on chain.
Yeah, absolutely. And I remember that this was one of the early wins for Uniswap, and why people got so excited at the beginning of DeFi summer was that you actually had better price execution happening for the long tail of crypto assets on Uniswap than on the Coinbases or Binances of the world. And I wonder if this trend of just more and more assets getting issued on chain is the long tail has actually gotten more and more valuable in terms of a space to be at. And if there's a trend here of Austin, you and I were chatting earlier today about this idea of internet capital markets. And I know Multicoin recently published a thesis on this. I know, Austin, this is something that you've thought about for quite some time. And Jesse, it sounds like you as well. But maybe you could connect this idea of one of the structural advantages of DEXs of being able to permissionally list kind of with this idea of, global internet scale capital markets with just more permissionless, less friction, et cetera. Maybe slot, DEXs within that greater vision.
Yeah, I think like the key thing about like internet capital markets is like the internet has fundamentally changed almost how every business works. Now, like you previously, one of the key benefits of IPOing was that like other people know you exist and they'll work with you. But now you just put on like a Google ad or you reach out to them through email. It's fundamentally changed how almost all business works in the US and in the world in general. And so I think that continues with like this the ability to list in a decentralized way and let everyone in the world see your asset and trade it. It just makes so much sense, right? Like, why are you letting like 5 people at the New York Stock Exchange look and be able to trade your asset when you can have every single person? That's like what an asset issuer wants, right? They want to be in as many eyes, many buying eyes as humanly possible. And I think like that is why decentralized will win, because it's the you don't have to ask to be in the room, you're in there automatically, and you can trade if you think there's value in something.
You know what else outside of even just distribution, I would say, is like concrete examples of maybe I would point to some of the early signs that DEXs are winning here is, it used to be, and it still probably is very important to get a SEX listing, but at least on some of these meme coins, you kind of had the early price discovery take place on DEXs, and then everyone was waiting for a SEX basically to dump their meme, and the SEX sort of became exit liquidity, right? So the gap in between when it got listed on a DEX versus a SEX actually became pretty important, and the SEX listing, I think, has more become an exit liquidity thing than anything else. And yeah, I just think it's kind of an early example, right, of this actually working in practice, I would say.
I have a slightly different take on certain squaring DEX with this idea of internet capital markets. So I think to me the most exciting sort of takeaway. I actually don't know if this is covered in the multi-coin post, but like when I hear the term internet capital markets, what's most exciting to me is the internet like changed what we define as information. Prior to the internet, right? Like, for example, news, right, came through the New York Times and like, mainstream media. And now like, all the world's information is bits, and therefore the way we consume that information is wildly different than pre-internet, right? And I think the same is going to be true for capital, right? So like before internet capital markets, right, like we had certain types of capital in the world. And, post internet capital markets, the type of capital that we're going to have in the world is going to be very different. And I think you're already starting to see this with meme coins, right? Like meme coins are a new asset class. I think that's the right way to think about meme coins. It's an asset class that monetizes attention on the internet directly. And you couldn't do that before you had internet capital markets, right? Like you couldn't, but before you could tokenize memes, you couldn't have capital formation around them. And so to me, that's kind of the most exciting and interesting angle on internet capital markets. Sure, we can tokenize all the stocks and bonds and all the traditional capital and bring all that on chain, but we can also like create entirely new forms of capital through this vehicle of tokens, right? So like I always like this kind of analogy where the internet turned all the world's information into packets, and I think the same thing is going to happen to all the world's value, where it becomes tokens, and there's all this value in the world that has never had a vehicle for markets to form around them. Like memes, and tokens solve that problem. So to me, that's like, that's why DEXs win, is because, again, it comes back to this permissionless idea. If you're able to take all this like fuzzy capital in the world and formalize it in the form of tokens, then the path of least resistance to liquidity for those assets is decentralized exchange, because they're permissionless. So that, to me, that's how this also, DEX is square with internet capital markets. It's like we can have capital markets that we could never dream of before, and you can only do it on DEX because that's the path of least resistance. The sexes will always be late.
Totally. And then once you build up a use case, right, you get some sort of network effects, like liquidity network effects or whatever it is for this new form of capital. And one thing that I have found that some pretty interesting in general is that the market for like memes have mostly found a home on Solana via pump fund. And my thesis going into this was that was going to be extremely mercenary capital, right? This is kind of the hot ball of money that you probably see as a protocol operator, which is you kind of got your core users and then these sort of mercenaries that rotate across different protocols, either farm or do whatever. But it's actually been pretty sticky. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. And you've had different competitors vie for that throne, like Base and everything that they're doing, but sort of seems like it's been much stickier than I thought over on Pumped Up Fun and Solana. And I guess my question to both of you is, has that surprised you? And then, writ large in this whole Ethereum versus Solana debate is, I think Solana has taken an enormous amount of activity and fees away from Ethereum. And it's unclear to me whether Ethereum or the L2s really want that back. I would say they probably do, but I'm curious about whether or not you think that the combo of Ethereum and its L2s ecosystem has the ability to take that back from Solana now.
I mean, so certainly Pumped Up Fun is absolutely killing it, and yeah, I do think they have today a real network effect at play in the platform, because Pumped Up Fun is the place you go to discover new meme coins. Or I don't really love the term meme coins; I just call them memes. But you discover memes, and there are markets there, and so that's a venue where you trade. So I think it's sticky, and zooming out again, 10 years from now, I think meme coins as an asset class are going to be around and be much larger in terms of total size of the asset class. Now, I'm also a believer that end users really don't care where they're trading. They just want to access the market, and so I do think there's room for other folks to build products in this space. I don't know that Pump Fun is the be all end all for meme coins as an asset class. There's probably room for others to play here. And so I think jury's still out as to whether, which chain retains the volume. And again, it's whatever product offers the best user experience will probably end up abstracting the chain from the end user at some point. So yeah, I take a kind of long view, and I think there's room for diversity here.
Yeah, I definitely think one reason why Pump is winning, first off, they're very good builders and they're executing very well. But I think a second reason is there's been very little changes in sort of the market structure. It sort of seems like people, when they go to Base or they go to Ethereum, they're sort of copy pasting the same mechanism. And so if it's the same user experience, it's the same value creation, why would you trade on anywhere else except for Pump? That, if they have more network effects, they're going to win every single time. And so we believe that by pushing on, by making a better mechanism that's maybe more value capture or is less lossy, you can get the same effect with less attention, and that attention will flywheel to being more once you reach the same amount of levels of attention. So I think that to me is the way that I feel people other than Pump will win, is by having sort of a less lossy system, or just capturing new forms of asset issuance that are past meme coins.
Well, Austin, what do you mean by lossy?
Yeah, so I think one thing I think a lot about is there's money that's created when a user creates a Pump token. There's value in that Pump token, and people are trading it, and a lot of people are willing to buy these tokens for the Solana that they have. But it's unclear how much of that value that's being put into the system comes out of it in the forms of the token price. And if you have more loss, the token price, it doesn't go up as high, it goes down a lot more. And so to me, that's purely a form of just MEV, the same as any MEV happenings on sandwiching or happens with LPs. It's the same exact thing there.
Well, yeah, I think this gets into an interesting topic that frankly Austin's much better equipped to talk about than I am. But you were asking about Solana versus Ethereum and sort of how that evolves with meme coins, and I do think directly adjacent to all this is MEV, right? Is there's a ton of MEV happening to do with meme coins on Solana. To Austin's point, right? Maybe there needs to be some breakthrough in mechanism design that mitigates MEV, and as a result creates a better market structure. Maybe that's one vector on which you can innovate in the meme coin space, where there are strong network effects today. So yeah, I think that's an interesting. Like I was suggesting, product is the way, right? Like maybe you have to build a better product. I think there is this other dimension that Austin's right to point out, which is like maybe you can come up with a better mechanism where there's actually better value accrual for creators or asset issuers and the patrons or people investing in those assets. Um, so anyway, that's a topic we can get into.
Yeah, this is probably a good. I would like to transition actually now into talking about Austin, what you're building at with Doppler, and maybe we can talk about some of the. I think the big trend is what we've been discussing here, which is just the sheer volume of asset issuance that is happening, primarily in the meme market, but across the board as well. And also, maybe could you talk for a little bit about what are the pain points that exist today from the perspective of someone that wants to issue a token, and then we can get into how Doppler is solving those.
Yeah, I think like for meme coins, we see like one problem that we sort of see with meme coins is the inefficiency of the market and how the value capturing is very difficult for them. And what we are sort of thinking about at Whetstone is like how do we build a system that lets users not think about like what's the best system for them or the best use case for them, and they can focus on building their product. We've actually seen like one thing that really made me interested in this design space is seeing real protocols and real applications wanting this instant liquidity from Pump. So they will issue like they'll make a product with their token. And that will be the token for their whole product. And they use Pump to do that because there's not really any alternatives for them. But one of the problems there's a few problems with Pump there is like it's a pretty one size fits all solution. Like if you have a very large token or you are having like a real product, maybe the selling going fair launch at like $69,000 is not a good use case for you. You want to have like a more flexible solution. So we think that like the world that we're going to see a lot of tokens that are issued that are past just meme coins. They're also like products, that they're ecosystems or their applications, and the selling sort of all of their tokens at such a low price is not feasible for them. And we think that like one of the ways you can solve that is by having a system that's more modular, it's more flexible, and it's not as sort of like putting everyone in the same sort of like the peg in the same hole as everyone else. And so that's sort of what we have built at Whetstone is like we're building the system that sort of evolves with how the market has evolved over time. So like if you have a big product and you have a ton of demand very early on for your asset, Doppler will adjust to the market conditions to try to get you as much money as possible for your token.
Okay, so I want to actually get a little bit concrete here, and not to pick on Pump, not picking on Pump at all, but there's sort of the dominant place where early price discovery happens for memes today, and then ultimately that ends up graduating to a pool on Radium or something like that. So for folks who might not be as familiar with the mechanics and what it looks like under the hood, can you just describe a little bit about how price discovery happens on Pump today and the migration into like another pool, and then maybe we can start to highlight what some of the challenges are, how it could look differently, right, with what you're building at Doppler.
Yeah. So I think like the rough thing that Pump does is they take a share of the token supply, they put it in an AMM at a certain static price, and then if you go past that, so it's like a simple position they put in there, and then if the token price, if enough people buy that token, it migrates to Radium according to like a static amount out. And so usually what that means is like it starts at a really low price, and enough people buy to make the whole token ecosystem worth more than $69,000. It migrates to Radium. But there's actually like a lot of problems with that. Like, what if the token you're trying to issue, it's higher than 69,000? You don't need this price discovery, this like low level price discovery at such a low price. And then one of the other things is like the LP supply is burned, which is like a huge amount of capital the system has created that like would be very valuable for token issuers to have. And the system, like it's sort of like a one size fits all system. So we've seen like a lot of people, they'll issue their meme coin or their token on Pump. It'll immediately bond. It'll just get ran through immediately by a bunch of sniper bots, and then they immediately dump it because retail traders have come in to trade for them. It's actually like not necessary. It's not like a requirement. You can improve on that mechanism quite greatly to limit retail losses, to limit amount of sniping, to limit the lossy the like losing value at different places in the system.
So I want to get a sense as well of, this is one of those things where, if you've ever watched one of these tokens on Pump Fund run, right, it looks like kind of this crazy, shooting up pattern, maybe a little dip and then a shooting up pattern, something like that. And then, it's either the next fart coin or it's, you're cooked. And so,
Yes, yeah.
Maybe what I hear you advocating for here is, okay, there are some issuers that know already, maybe it's because they've got an audience or a brand or some form of, they've innovated on distribution or whatever it is, that this is going to be, we don't need to start at effectively zero here for a price. And actually we can start at a price equilibrium, which makes a lot more sense. And then the other thing too, is that, maybe there's reason to not actually have, if you have a longer term time horizon on your project, that you don't actually want a chart which rips 10,000% in 2 days, because then it's got nowhere to go but down. So is that roughly kind of what we should be expecting here in terms of like flexibility and how like a price chart might look like going live on Doppler versus Pump Fund?
Yeah, it's like one of the reasons why you have that really fast run up and that drop. It's like very baked in. You see it in almost every single chart on all Pump Fund coins, is because of the sort of sniping mechanism that happens. Is that like the earliest sniper bots buy, retail users come in, they sort of hit the top and the sniper bots sell. That's why it creates that pattern almost every single time. And that's just because of like the there's no anti-sniping protection built inside the protocol. And so we're hoping to get rid of that. Instead of the MEV bots capturing that sort of run up and then run down, the token price itself, or the token itself, captures that value. So instead of like having this run up and down, you just sort of like have this more seamless experience and with your price chart. And yeah, like there's a lot of other sort of things that we can do, like vesting has been in our protocol for a while. Modular things you can do with the fees of the protocol have been in ours a while. So you could do things like bootstrap a lending pool or bridge assets across chain, and create new liquidity pools on new ecosystems, all sort of inside the core primitive. So users don't have to do these things. Instead, the system themselves does it. And they are like well audited. They're done by hopefully professional developers. And so all that token issuers have to do is sort of like either go to an interface that has those support, or just like sort of click the buttons for the features they want for their token. And we think that like that's like a very modular yet strong experience for these token issuers, because like they want flexibility. They don't want to think about like, is my thing safe? Is like, what should I use? Like, I think they just sort of want a high quality experience that does the action they want in the tokenization market.
Maybe I can jump in and sort of take a stab at some of the issues I see with token issuance generally. So I think one thing, starting with one thing Pump did really well, is they standardized issuance, and they made it easy for anyone to do it, right? So like prior to Pump, launching a meme coin was hard. You had to like deploy smart contracts. Those smart contracts may or may not be audited. They often were custom built. They often had bugs, and people got rugged just technically. So Pump kind of fixed that. But to Austin's point, they fixed it by giving everyone a one size fits all solution. So I think one of the opportunities that exists in the market for issuing tokens is to have more control over your issuance, and that's what Austin's been talking about here. Is right. You want to give asset issuers, whether it's a meme coin or a startup, tools to customize the curve on which their price is going to move. And in so doing, like in giving those tools to issuers, you can also solve another problem that exists with Pump, which is sniping, right? So the curve, that because it starts at zero and it's meant to run up to 69,420, it invites snipers to just front run everybody and like accrue as much of the token as possible. And then right when it gets up to that, high water mark of 69,420, they just dump or get out. The snipers get out. And so you can have a different curve that basically sells less of the tokens earlier on. And as a result, disadvantages snipers who are playing the front running game. The result of that, of course, is like, well, real authentic community members who want to invest in your project can get in, and not, they don't have to compete directly against the snipers who are at a, distinct advantage. So that those are like two. I think that's very low hanging fruit for for optimizations on token issuance is like, let's make it so issuers can customize their curve and like optimize for different things, and also let's make sure that investors can get in as opposed to bots. So that's the low hanging fruit. Anything else you'd add, Austin?
Yeah, I think like one thing that we're really, really excited about is this ability to do more things with your liquidity. So Pump, for example, burns the LP supply to ensure that they have liquidity to trade. But you could do more things with that. Like you could initialize a lending pool on Morpho. You could bridge some of that liquidity cross chain. You could like create an Oracle pool to have an Oracle for your protocol. And so by having this programmability, you could like another thing you could do is you could use some of the LP fees to do buyback and burns for your token. So with the ability to have like this system in which you can pick multiple things, you can do a lot of extensions to the core protocol that enable specific user experiences that are desirable for the builders. Like maybe a builder wants to get their token everywhere. They want to let anyone trade on any ecosystem. With the Doppler stuff, they can click and go everywhere without having to think about it. And they outsource this to the Doppler protocol and these sort of like audited smart contracts. So they can look at them themselves. They can audit them. They can see the audits, or they can just sort of trust that like the auditors have picked these things up.
That's super interesting. I'm even thinking about maybe some like one form of value pool that I know some protocols are interested in, right? There's kind of like the buyback and burn, or there's actually LPing their own tokens. So somewhere where that might make sense is like the ETH LDO pair or something like that, or Steth LDO or whatever. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today. So that's super interesting. This is a podcast for massive nerds, as both of you guys know. So can we actually get into a little bit of some of the mechanics actually that you're doing on the curve for Doppler and how you guys do like what the pricing mechanism looks like there?
Yeah, so there's two protocols. There was the one Jesse's talking about, the V3 version, where we modulate out the steepness of the curve to make it run up faster for earlier buyers. But I think the Doppler V4 version is much more interesting. It uses a lot of the benefits of V4 natively. And how it sort of works is we run a bunch of these sort of, if you have a big token supply, say you have 10,000 tokens, you split them up into like 100 different sub auctions. So you're selling, 100 tokens per block or sort of per period. We put those tokens into the pool, or sort of the hook itself puts the tokens into the pool, the Uniswap V4 pool, and it looks at like all the buyers and sellers coming into that pool over that period. And if we had more buyers than we had sellers, or we had like then we increase the price for the next period. If we had fewer buyers than we expected, we decrease the price for the next period. And so what it's doing is period by period, it has this target price and this target increase in price. If it doesn't reach it, it says like, oh, okay, then we didn't have enough buyers. We're selling it too high. And so it'll decrease the token price that it's offering for the next period. And then continues to do this over and over and over again as like it attempts to reach a specific price at the end in a very smooth way. And that's done all inside the hook. It's done all on chain. Users don't have to do anything. It all executes inside the hook. And that's really valuable because users who are swappers, they don't see any of this. All they do is they're swapping, they're selling, they're buying the token, and we're keeping track of all this information inside the hook in sort of a cool way you can read in our white paper. And period to period, we're adjusting things slightly to get as much token value out as possible. The important part about this is that like you're minimizing the loss that your system takes period to period. Like what we're trying to do at Doppler is like, we want to minimize the amount of losses that come to MEV, and we want to maximize the value that we gain from that MEV. And so in some sense, like these MEV users are arbitraging, they're setting the price. everyone in the sort of market is fighting over what price to set the Doppler pool at. And we're saying, okay, cool. Everyone's fought period to period. They've come up with this price. That must be right. Now, how can we adjust based off that market information to update for the next period? And so by limiting the amount you're going to lose to arbitrage, you and maximizing the value you get out of it, you have a very, very efficient system for pricing. And you're using sort of the global market to price these assets through just buying and selling. So you can sort of turn like global demand for any asset into a price, which is a sort of like turning like how price discovery has worked previously, which is like a market maker or an underwriter prices something. Instead, what we're doing is we're letting every market maker and every underwriter fight to set a price, and then we're saying like, thank you for your service. We're gonna go on and use that for our price.
That's very clever. For listeners who might not be super aware of this dynamic, this is kind of like the DEX arbitrage, right? Where the assumption is that the price of an asset like ETH is actually set on Binance, and then like all of the AMM pools that exist on something like Ethereum, which has 12-second block times, are stale, and then essentially like a Uni V3 pool is paying arbitrageurs to move the price of ETH back to whatever it is on Binance. And in extremely volatile periods, there's not necessarily a cap, as the only cap is how large the pool is and how far the price can move on a 12-second window. And sometimes that can be huge. And that loss is generally referred to as lever. What's very interesting about your design, Austin, which reminds me a little bit of 1559, actually, is how you actually are using that same, your arbitrageurs are still telling you they're giving you valuable market input for the price of ETH, but you're limiting the loss by the amount of inventory that you're setting available, right? So it's just a very elegant design, actually. I'd say.
It's sort of an EIP 1559. It's an on-chain auction. It sort of does all these things because you're just letting the market price these things, and it's like, why don't we let everyone fight over it instead of like having one person who picks it and is probably wrong.
Austin, I think also like can you unpack why this is like sniper protection baked in?
Yeah, so I think like there is a lot of benefits to doing this, because if snipers believe the price is a certain price, they one of the core primitives is that the protocol moves against them. So if like they move the price up a bunch, instead of facilitating the trade on the other side, the protocol says, okay, thank you, like I'm going to close the door behind you. And it consistently does not let you just liquidate for free on the other side. And so what that does is it makes it extraordinarily risky to snipe. You have to sort of believe, like you have to have some valuation of the token, some value that you believe the token's at, because it could go down from there. And that's very valuable, because you want to, if you have sort of a static AMM where the price starts here and the price ends here, and people are buying and selling, people can sell back instantly at any time and realize the sniping gains. But what we're doing is we're saying like, okay, you move the price here, we're going to move the AMM price to here now. There's no way to exit in a way that's like you can't be guaranteed to exit at a better price. And so we're taking a lot of the risk that like actually retail buyers are just routinely taking. Like they have this exact same risk. We're giving some of that risk that retail buyers, and we're giving it to the snipers. And we're saying like, okay, if you can't just buy everything because the price might go down, and if that's true, you lose money. And so it's not free anymore. But in some sense, like this is the same risk that retail buyers are taking every day. Like the price can go down, they don't know. And they're saying like, I think this is going to go up, I'm going to buy it. So they have some idea of the valuation or like the value of the system in their head. And so instead of like being the first person to buy and like that's who wins every time, it's the person who is best able to value something. And like if they think this has value, they buy it. If they don't think it has value, they sell it. And like if someone's the best buyer, like a programmatic buyer, aren't they just the best, like hedge fund? Like that's like a programmatic hedge fund at some point, right? Like if you're able to look at an asset, say this is what the value is, and buy and sell that, like that's actually just good. That just means like you're just a good investor at that point. And like if you're a good programmatic investor, like more power to you in some sense.
But critically, like they're good at pricing something, they're not good at being first, right? And that's the key. Yeah. That's the key difference.
Yeah.
Totally. And that's actually providing a valuable service to the market, right? Is moving the price to where it ought to be from a theoretical fundamental value perspective or whatever it is. I got one more question for you in terms of just the mechanism here and how it works. And then I want to move on to why, a little bit more about your decision to launch this as a hook on V4 as opposed to launching it as a standalone DEX. You were alluding to it at the top of the episode, but I just want to get into more of the specifics. Can you just talk a little bit about the mechanism of the auction here? So this is a Dutch auction. So why, outside of your time with Dan Robinson, did you decide to use a Dutch auction versus other options here? And then I'd be curious in terms of how you actually incorporate some of the information that different buyers give you into the magnitude of how much you're actually going to move this price, right? Like, is there if the inventory gets snapped up in a certain period of time, or like, how do you actually determine the sort of magnitude of the price move? Or is that just a standardized thing that it goes up by, X units?
Yeah, so it's actually like pretty interesting. The reason we use a Dutch auction is because if we don't have anything available to sell below a certain price, users can't sell into us. So we have no notion of the price in some sense. Like the only notion that we have is that the current price we're willing to sell the asset at is too high. So we have no idea what the actual price is. We just Dutch auction down another peg and say like, okay, our now users are going to trade against us. And if they don't, we just continue to Dutch auction down. The other side is how we set the price going up. And what we do is we have this like very, very long, we have like we call it an upper slug, but it's like a very concentrated position over like from epoch to like one epoch to the next epoch. And then we have this really, really long thin position above that price. And so users can trade into this very thin liquidity section. And so that's like we set the prices purely based off of where the users are trading into. And this is sort of thin liquidity amount. And that's like how the price goes up. And so users can set like a max amount they want it to go up epoch to epoch, sub auction to sub auction. And they do that through like a parameterization in that they give to the core contracts when it's initialized. But like in some sense, like we don't really care about the price going up is actually like much easier than the price going down because you have some market information when the price goes up because users are buying these things. When not enough people buy, you have no market information, so you just got to go down.
Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed code base ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3 without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there's a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today. All right, I want to get your take on why, what was behind your decision to launch this as a V4 hook? And for listeners who might not be aware, Austin, I knew you were very instrumental in terms of designing V4 yourself, Uniswap V4. And so just wanted to get a sense of the benefit, maybe the pros and cons of launching as a hook versus a standalone AMM.
Yeah, I think the benefit of like Uniswap v4 for us specifically was the ability to build on top of like a very secure layer. Like I think people every day could build maybe a slightly better thing like every application could build a slightly better chain for themselves than Ethereum or Solana, but like it's really, really hard to do that. And so in some sense, like we use a system that's like extremely well tested. It has a huge bug bounty. It's been audited like 5 or 6 times. And we have to do so much less internally to achieve the same outcome. And so for us, like we built Doppler in 3 months. And we think that like it would take year or so to build on top of its own customized AMM, and it would probably be less secure. It would take a ton more audit time. It would take a bunch more testing, and so we're outsourcing a lot of these fundamental trading that we want to do, like the fundamental actions that Uniswap gives us, to the core contracts, and we sort of just like let users trust that instead. And another reason we did this is like to utilize our core contracts, you only have to trust that Uniswap v4 works. If you're buying and selling, you just have to trust that. And we think that's a much better trade-off for users to only trust the core Uniswap contracts, because like they're very well they're much better audited than ours. Like, we spent a lot of money on really good audits, but they spent a lot more, and like they have a much larger bug bounty, and so it's like we can use their security budget as our security budget to go faster.
Isn't there one other reason also, which is that Uniswap has a lot of integrations. The protocol has a lot of integrations, right? And so like in building on top of it, right, all the assets that launch with Doppler, because you're using Uniswap core contracts, like they're going to be discoverable by the router. And so, anyone that's integrating the core protocol is going to see those assets right when they launch, see those pools, and be able to distribute that liquidity everywhere.
Yeah, exactly. So like in our current like specs that we have, like the current interface we have to sign, the moment you click create on a token on Doppler, you can open up a tab to the Uniswap interface and trade it immediately. And so it's like there is no, to Uniswap, to every single integrator with Uniswap, it just looks like a Uniswap pool. Because it is just a Uniswap pool. And so it's like these integrations are their integrations or our integrations.
And I would just diff that versus like, for example, on Base, you have Virtuals, right? And Virtuals is a platform that's issuing a lot of tokens on Base today. And similar to Pump Fund, like they have their own kind of curve, their own pools for these newly issued assets, right? And so the result of them building it themselves is, number one, like the team has to build and maintain all that. Like they've had, bugs that they've had to fix and so on. But also like all those tokens like are not discoverable anywhere else tokens are traded. You have to go to Virtual's website to trade them. And so like Doppler kind of solves all these problems. It's like the safety problem, the developer friction of building your own thing, and the discovery problem. Like you launch on Doppler, you're everywhere Uniswap is.
So and the other thing too that this made me think about is just time to market here. Like however long it would have taken you to build this DEX standalone. I think Austin, you were mentioning when we were talking before, it could have been anywhere from a year and a half to, and you maybe cut that time in a third. The other thing too is just even just from my understanding, the access to good auditors is just more bottlenecked than it's ever been. Also extremely expensive. So there's a very real cost here, but there's also just a very real possibility that you might not be able to get the individual that you want, right, at some of these security firms. So just the ability to bootstrap off that is super important. One question maybe is like a little bit of, I don't know if you view this as a drawback, but the drawback of the integration point, which is point well taken, is you also maybe lose the direct relationship with your user, right? Like if people are, you get to plug immediately into Uniswap and their order flow, et cetera, and people just think they're trading on another Uniswap pool. Maybe the drawback of that is that people just think they're trading on Uniswap, and so that you become a component that they could just swap out. So how do you think about the relationship with the user here at all?
Yeah, I think like in some sense, like this is a problem that all tokens have. Like they, when they're issued and they're working on top of Uniswap, like I would say that users have internalized the differences of like between the exchange and the token itself. But I do think that like at the end of the day, the Uniswap sort of trading brings the token integrator, it brings the token, and it ultimately brings the Doppler protocol a lot of value. And so I think that like losing that customer potentially is not as impactful as just like being everywhere and being sort of like a core primitive. I would say that like people don't think about like for Uniswap, they're not saying like, oh, you're just Ethereum, but like at the end of the day, they're interacting with Ethereum, right? Like people don't think of like just Pump as Solana. It's in some sense like they internalize there's a difference between like the places the tokens are being issued and like the platform they're being built on. And so I think that like people will understand that very deeply, but like they'll see like the issuance versus the trading of those things.
Yeah, I think it's important to distinguish, like going back to like early in their conversation, I was drawing the distinction between issuance and exchange. and they're kind of like two different user personas, right? The exchange component is we're really talking about secondary markets, and issuance we're talking about primary markets, and there's a different user persona there, which is the asset issuer is an important part of asset issuance, whereas like exchange, the asset issuer is not necessarily there. So I think Uniswap and all the places Uniswap is integrated, they serve the investor, the exchange, the person who's using Uniswap for exchange, but they don't currently serve the issuer. And Doppler serves the issuer by giving them all these tools. And when I say issuer, I should be more specific. Like what do I actually mean? So it could be somebody launching a meme coin directly on. Well, there's this product Pure Markets that's going to build on top of Doppler, right? And you could do meme coins there. And so it could be a creator launching a meme coin. It could also be a platform like Virtuals, right? Like something like Virtuals could use Doppler, and Virtuals and Pump, they solve a very important problem for users, which is discovery. Like there's curation that happens on the platform. Like they have a feed, right? Like, so you can kind of see what's going on. And so I would just see this as sort of like unbundling different jobs to be done, right? There's always going to be, like what Doppler introduces is a tool that solves does a job for asset issuers. It makes their pricing more efficient, more resistant to snipers. Then on top of that, you're going to have interfaces, and they solve the discovery problem in primary markets, and then you have secondary markets. And that's Uniswap solves that problem very well, right? Wherever Uniswap's integrated, you can trade that token. So there's kind of three different personas to solve for here.
Yeah, and maybe we could talk a little bit. We just touched on this, I believe, at the top of the episode. But Jesse, you just mentioned Pure Markets, which is the interface that you're building. Austin, can you just describe a little bit about what Pure Markets is and where it fits into your vision?
Yeah, so it's sort of the first product that's going to be built on top of Doppler. It's by our team. It's mostly just to be a place and a home for tokens, Doppler tokens specifically, to explore them, but also to swap them and to create them on all the chains that Doppler is deployed on. And it's also allows swapping for any user. So like a very quick, very fast experience for issuers who are sort of like traders who just want like a system that works very quickly, gets them a route for any token they want. That's built on top of Uniswap. And so we're really focused on just like a quick, easy user experience. It's very simple. And this is like very just like turn your brain off and buy, because I think like that's like at the end of the day, what users don't want to think about all these things. They just want like to get the action they want. And so we're focused on like having a home and having a sort of like a shelling point for all Doppler tokens that like, even if they're issued off of the Pure Markets platform, they'll show up on the Doppler interface, because it's like at the end of the day, we just want to get as much flow into the underlying tokens that are launched on the Doppler protocol and be sort of like a hub or a shelling point for issuance. And we sort of hope that Pure Markets is like the first place that people can do it. But at the same time, like even when people build other protocols or other interfaces, they still benefit from having like the Pure Markets interface to bring them flow.
Okay. So any closing comments on Pure Markets, Doppler, or anything like that? I want to just close by just asking you guys about like what you find interesting in terms of trends in DEXs. But yeah, any closing statements on or we can
maybe hoping, I don't know. I don't think we have like anything specific, but what do you think, Jesse?
Well, so I don't know when this episode's going to come out, but when does it launch?
A week, 1 week from today.
Okay, perfect. So, yeah, so we're hoping to launch February 10th. Is the hopeful launch date for both Doppler and for Pure. And so that will be shortly after this episode comes out, I guess. But really excited for that. And if you want to sort of follow along, you can follow me on Twitter or follow the Westone Twitter, and we'll be tweeting a lot about like these things as they come out.
Awesome. All right, guys, very exciting. Very soon also, so that'll be very cool. Yes. All right, so maybe just in closing here, like I would love to get a sense, Austin, as one of the premier DEX designers in crypto, like what are some of the trends that you are looking at? Like, I mean, we talked a little bit offline about Fluid and sort of this combination of lending and DEXs under one protocol, and maximizing for capital efficiency there. Anything else that you're kind of looking at as inspiration, or you think this is a cool experiment, or anything like that?
Yeah, I think like Sorella is obviously very interesting, using like these off-chain auctions. love their team. I think the Bunny team with Zephyrum has done a really great job. But I think just like sort of past Uniswap, there's a lot of sort of modular dexes that are coming out. Like the Volantis team has been doing a very interesting job thinking about like a pure modular dex. And I think like the Fluid team has done a really cool job of like, how do we combine two primitives and one to sort of get a better experience? Like they sort of combine two primitives and get a better experience than each of them apart. I think we're going to see more and more things like that, especially built on like Ethereum, where it's like people building these, connecting two things that haven't been connected together, and they're more efficient when they're sort of built into each other. I think that's like a very big benefit of the modular design, is that like it's easy to hook things up together. And so I sort of suspect like that will be a big thing. But I think like one of the things we're going to see enabled by modularity is a lot of smaller changes over time. Like, Uniswap V2 to V3 to V4, they all took like 2 to 3 years to get the next design of the DEX out. I think on like V4 and these modular DEXs, we're going to see like, monthly updates or like bi-weekly updates where it's like these little small changes. And by the time like you would normally see like a V5 be announced, like it's functionally already out in some sense. It's just like a culmination of all the little improvements that have been made over time. And I think like that is the future, is like instead of like just having to wait 2 years and then trying to guess what will be important in those 2 years, you're going to see a lot more of people building innovations much closer to launch, much closer to the tip, and sort of like those innovations will stack up on top of each other. And I think we'll functionally see a Uniswap V5 on top of Uniswap V4. And it'll be sort of just like a culmination of all the cool features people have done. And then it'll be a lot easier to build a V5 because it's just sort of like, building like the things that have already been built for V4.
And then maybe, Jesse, in closing for you here, a question is, so maybe less on the DEX side of things, but on the asset issuance side of things, we've seen just the sheer amount of assets that are being issued on chain today has overwhelmed definitely the sexes of the world. And I'm very curious, what you think about just in terms of trends there, like whether or not that's sustainable. And then the other trend I'd be curious to get your perspective on is this idea of sort of progressive decentralization and when teams should launch tokens within their life cycle, right? It's kind of changed over the years from you wait until you have something very built out, and then you launch a token to launch a token and then kind of build the product afterwards.
Yeah, totally. So yeah, just to put numbers on it, I think like last I checked, with the number of tokens being launched weekly is something like, I think it's like 400 or 500,000 tokens are being launched every single week now. Pump is making up a large chunk of that. And that's up like 20x from like a year ago or something. And that's only gonna continue in my view. And now again, today it's mostly meme coins. But that's starting to change. Like I think virtuals is probably the best known example for people like following the meta around AI agents, right? These are arguably meme coins, but they're attempting to be more than that, right? Like they're meme coins associated with an agent that is prospectively going to do something, whether it's like social media influencing or something on chain. And so, 5 years ago, I wrote this piece on about progressive decentralization, and basically recommended that projects take this approach of first building a product, finding product market fit, and only after you found product market fit, launching a token to distribute ownership of that product or protocol to the community. And I think that was inspired. It's important to note, like, this came after ICOs, right? So ICOs in 2017 did the exact opposite of this, where it was like you started with a white paper and launched a token and sold the token, and you had no product. And very often you never got a product because the people selling the token just went off into the sunset. But in other cases, you did get a product and it turned out nobody wanted that product to begin with, and the token went to zero. So the progressive decentralization playbook kind of suggested, hey, like do the traditional sort of thing, build the product people want, find product market fit, then use tokens as a way to grow the product by aligning the economics of that product with the users who are contributing to it every day. And I think that playbook still makes a ton of sense, and generally is like good advice for founders building in the space. That said, I think there's a lot of merit to bringing the token forward earlier into the life of a project, because it has this really powerful effect of getting users excited about what you're building and incentivizing them to contribute. So I've been kind of tossing around this idea of progressive utility, wherein you kind of bring the token forward in the life cycle of the project, and you progressively add more and more utility to the token over time, including functional decentralization. I think a really good example of this is Hyperliquid. So Hyperliquid did build a product people want, and they got product market fit, but they launched a token like relatively early on, right? Like they have ambition to be an L1. They're pretty far from being a true L1 today, but yet they have a token. So I think they wouldn't necessarily meet the definition of sufficiently decentralized as compared with most blockchains. But yet they have a token. And I think that was smart of them to do, because it really incentivized people to use the product and to build in the ecosystem. And so what I've been kind of mulling around, this is still like kind of half baked, to be honest, is that where it makes sense to launch a token earlier, maybe when you're building a platform where you need or you want third parties to build on top of that platform, and specifically like build their own businesses on top. Where your token can serve as this sort of like liquidity reserve for the tokens that get deployed on top. So Virtuals is a good example of what I'm describing here. Hyperliquid may be another. But with Virtuals, you have the Virtuals token. It also launched in tandem with the product itself. And the product enables people to launch their own tokens, build their own businesses. Mm-hmm. The Virtuals token serves as a liquidity pair for all the tokens that launch on top. So, the idea here is that like by pulling the token forward earlier into the life cycle of the product, you create an incentive for people to build on top and engage with the product. It can help you find product market fit in some select cases, and it can have some early utility, which out of the gate can just be liquidity for all the tokens in that ecosystem, and then you can progressively add more and more utility, like having users stake the token, doing rev share, and so on. So zooming out in the current administrative, regime that we're under now, I think there's more room to experiment with this. Progressive decentralization, I think made sense in 2020 and probably for the 4 years thereafter, because that playbook got you to a point of sufficient decentralization, which was really the only, viable way to launch a token from a compliance standpoint. I think progressive utility may be, fertile ground for experimentation in this administration, where there seems to be more flexibility on on the timeline to decentralization, basically. So I think like what I'd conclude by saying, I know that was a long rant, is we're going to see a lot more tokens. We're already seeing it. I think it's going to go exponential from here, and it's not just going to be meme coins. It's going to be real projects that are trying to build real utility, and so in order for that to happen, we need to get issuance right, so that users don't get sniped and burnt on the things that they actually want to use.
Yeah. And you know what? One thing that I would love to see as well is, and it feels like we're further along than we were even 12 or 18 months ago, is just price discovery happening on chain and then staying on chain. I would argue it's starting to happen on chain, actually. Like the whole Trump meme coin launch, that absolutely happened on chain. It was a big win for Solana. You saw huge stablecoin inflows into the ecosystem. You saw, I think it was like 40 billion of volume. It was like 1/10 of what NASDAQ does in a day. And it would just be great. I think eventually some of that ends up migrating onto sexes. So, it would be cool to just think about how we can, how we can keep that. And I think Doppler will be a big part of that in solving frictions for asset issuers, and then just keeping liquidity on chain.
I think the way that, just to respond to that really quick, I think you're starting to see Coinbase. You mentioned a few times, like Brian was tweeting about, we need to change our listing process. But you're also starting to see them just integrate DeFi protocols directly to the Coinbase.com app in a really meaningful way, right? Like they did this with Morpho, so you can like use Morpho to borrow against your Bitcoin. And for Coinbase.com users, it's completely abstracted. Like you don't need to know that it's on chain. It just works. So if I had to guess, like I think the way that price discovery stays on chain is Coinbase stops listing assets; they just integrate DEXs, and to their core product, and users of Coinbase.com don't know or need to care about that, and that's how all the volume just stays there. It never leaves. Like there's no other place for it to go.
And the Morpho Coinbase integration is, first of all, it's such a win for both teams, but I also love Morpho and we'll always root for them. So, but it's cool. It's like the DeFi mullet, right? That we've been talking about for many years. So in practice, guys, both of you have been super generous with your time. If folks want to find out more about the work that both of you are doing, I guess, Austin, a little bit more specifically with you with the launch coming up of Doppler, but where can folks kind of follow along more granularly and find out? But same question to you, Jesse. If people want to find out about the work that you're doing at Variant or read any of your blog posts or anything like that, what's the best way to do that?
Yeah, I guess I'm Austin Adams 10 at Twitter, and then the Whetstone Twitter is whetstone.cc. And yeah, you can see me yapping there. I love yapping on my Twitter. So you'll get to hear all my thoughts directly from my brain.
Nice.
Yeah. And yeah, all of my thinking is at variant.fund and jessewalden.com, and Twitter, I won't try. You can look me up. Warpcast is easy. It's just at Jesse on Warpcast.
Awesome. That's a good one.
Sweet. All right, guys. Well, I really appreciate both your time here. Congratulations, Austin, again on everything you're building. And yeah, we'll have to do this again sometime soon, guys.
Sounds good. All right.
Thanks for having us.